If you are tired of price hitting your stop loss and going the opposite direction into your take profit, waiting for this liquidity run to happen in order to enter the trade, but it never happens, trade goes without you. This is what I used to struggle with, and this is when I decided to dive deep into market structure and specifically advanced market structure. In this video, I will dive deep into advanced market structure and show you the difference between a liquidity grab and the break of structure. This will change the way you see the markets as it did for me, and it will finally give you your aha moment. Now, if you're wondering why you should learn from me, I'm funded with FTMO and CFT. I have been trading for more than 5 years, and I have been mentoring traders to becoming professional instead of staying at the beginner level. Let's dive into it. We have 3 steps. Step number 1, identifying what is a swing low and what is a swing high and when it is valid. Very important. Number 2, we're gonna define the rules of advanced market structure. And number 3, I'm gonna give you the practical application so we can implement this on the chart together. Let's dive into it. Step 1, what is the difference between swing high and swing low and when is it valid? So a swing high consists of 3 candles, one on the left side and one on the right side. And they both have to be lower wick than the one in the middle. The one in the middle needs to have the highest wick. Same as for a swing low. It consists of 3 candles and the lowest wick must be the one in the middle. Now we have some rules for that. For example, once we have 3 candles like this with a candle, this is called an inside bar, that does not go above or below the candle before it, this is not considered a swing high. Same as for the swing low. When we have the candle next to it does not go above or below, this is not considered a swing low. What we need to see is something like this. This is a swing high that consists of 4 candles. This swing high right here, this candle does not go above or below, so this should be something like this. It should not go above or below it, while this candle did go below it. Now this is considered a swing high. Same for the swing low right here. We can see that the price here did not go above or below in this inside bar, while this candle went above it. So now this is a swing low consisting of 4 candles instead of 3. So step 2, the rules of advanced market structure. A short-term high and a short-term low. So this is the smaller version, short-term high and the short-term low. Short-term high is a swing high, while short-term low is a swing low. As simple as that. The ones I explained them without anything, they are just swing high and swing low, short-term high, short-term low. Now, why am I telling you this? Because intermediate term high, right here, is a swing high with a short-term high to the left of it and a short-term high to the right of it. So if we have this is a short-term low, this is a short-term low, and this is short-term low. This right here becomes an intermediate term low, while this here is short-term low, and this right here is a short-term low. Okay, so this over here is an intermediate term low. And what does that mean? That means that this low is significant. Whenever we break this low, then we are about to break structure. We are breaking structure actually. While if we go below the short-term low, is just a liquidity grab. And this is why I'm explaining to you everything. So bear with me because I'm going to give you examples and I'm going to show you what I mean by this on the charts. So this is intermediate term low, which is a swing low to the left of it and the short-term low to the right of it. Short-term low to the left, short-term low to the right of it. For the high, we have the same situation. Okay, this is the same situation. This is a short-term high. This is intermediate term high. And this is short-term high. Okay, one to the left, one in the middle, one to the right, so this becomes intermediate term high. We don't want this to break. We want to see a liquidity grab here, considering that the trend is going lower. Okay, while here considering that the trend is going higher. Let's move on and show you what I mean by a long-term high. So long-term high is a swing high with an intermediate term high to the left of it and intermediate term high to the right of it. So let's consider that this is intermediate term high and this intermediate term high. This becomes a long-term high. Same for the long-term low. Swing high with an intermediate term low to the left of it and intermediate term low to the right of it. Okay, I see that I did a mistake here. Long-term high, swing high, long-term low is a swing low. So, my bad. And now we can continue. It's an intermediate term low to the left of it, intermediate term low to the right of it. This is what we can see here. So imagine this intermediate term low. Imagine this is now becomes a long-term low that if we have intermediate term low to the right of it. And what does this mean? That if we break this, we're gonna see a major change of trend that's gonna last for a while. The long-term high is the most powerful. The intermediate is gonna show us that we're changing, breaking of structure for now. But long-term is, as it says, long-term, right? It's gonna be like changing trend for a while. So let's go into some examples before we head into the chart. If I want you to tell me what do you see here, I'm gonna say that this is a swing high, correct? This is a swing high because we have this below it and this below it. Okay, it could consist also of 4 candles as I mentioned, and here we have a swing high. Also we have here a swing high. So this is a short-term high on the left, this is a short-term high on the right of it. In the middle we have our intermediate term high. Okay, this is, I want to see it how it looks on the chart. Let's take an example of intermediate term low. This is a short-term low. This is over here also a short-term low. Okay, and this is intermediate term low. I want you to see here as an example before we move into the chart. This is our intermediate term low right here. If the price comes and takes this short-term low from here, this is a liquidity grab. This does not change our buys, does not do anything. While if we go lower and take intermediate term low, now this is significant and it could mean a change of direction, change of trend. While here it does not mean anything, it's just a liquidity grab. And it's actually in our favor to price to take it and continue going higher. Over here we have another example where we have a short-term high, is short-term low, short-term low, short-term low. This becomes intermediate. So now the price goes below it. This is a liquidity grab. This is not a break of structure. This is a liquidity grab, and then we can continue higher. This is in our favor. While if it goes here, it's not in our favor. We have one more example before we go into the practical application on the charts. And here we're gonna see that again, we have here a short-term high, we have here a short-term high, and here a short-term high. Because we have short-term high to the left and short-term high to the right, now this in the middle becomes intermediate term high. The price could go above this and go lower. This is great for us. This is a liquidity grab. While if the price goes above this, that means we are breaking structure. These are rules in order to have rules in your trading and stop guessing. Okay, this is the reason we have rules for everything. So now we can go into the charts and see it in front of us. What do I mean by it? Here we have the chart of USD CAD, and as you can see we are bearish. Okay, it's the first thing we have to identify what is the trend, and we identify that by looking at the lows if we are breaking the intermediate term lows. So now we see that we have this short term low, we also have this swing low, and we have this swing low right here. Okay, so this right here becomes our intermediate term low. Why? Because it's in the middle of this swing low and this swing low, so this becomes our intermediate term low. Now if the price wants to come below it and continue higher, this is normal for us, it's totally fine, we can live with it, it's even better. Okay, so now if we want to keep going, we have, this is our swing low, it does not mean anything to us, this is still our intermediate term low. Okay, we keep going, we have another thing here which is our swing low. Okay, another swing low and another swing low. Okay, so this becomes our intermediate, so we can move this from here and actually put it here, but let's for now do this, and this is here now our short term low. So this is great, right? Because this is a liquidity grab which tells us that we're gonna go higher, and this is exactly what happened. Okay, but now this becomes a short-term low, exactly how it is, and here if we have a short-term low to the next to it, becomes intermediate. So this is the swing high that we can see, swing low, sorry. Again we see the price, if we do that again, we see that the price comes below it and go higher, which is totally fine. Okay, so now this becomes our intermediate term low. Our intermediate term low becomes the liquidity that took this short term low, becomes our intermediate term low. Okay, so this is short term, this intermediate term, and this is our new short term, because we have swing low, swing low, swing low. Okay, let's keep going and see what is gonna happen next. Okay, if this sounds confusing for you, with practice you're gonna be able to understand it. It's simple once you go through it more than once. So watch this video again in order to get to understand it better. Now, keeping in mind that the trend is actually bearish, we're gonna expect that an intermediate term low show us that we're gonna continue lower, because our bias is actually bearish. Okay, so our last intermediate term low was this, because this is the lowest candle we have right here. We had this, this, and then this and this, correct? Now we can see that the price took a liquidity grab from higher and went lower to take our intermediate term low. Okay, so now we're gonna look on the opposite side, we're gonna look at the highs, okay, to see the liquidity grabs happening on the other side. So because this is the liquidity grab from here before we go lower, and we have two swing highs, this becomes our intermediate term high. So if the price decided to go above this, it's totally fine. We don't have any break of structure to the upper side. Let's look a little bit more to the downside, what we can see. This right here is not a swing high. Okay, this is the swing high right here, and we don't have anything to the left of it. As you can see, we don't have anything. Okay, here we have another short-term high over here, another short-term high over here. Let's go a little bit lower to see what's happening here. We have now, at the time of this recording, we have this short-term high over here, and we have this short-term high over here, we have this short-term high over here. So this for now is our last short-term high. If we do not cross this and we just make a swing high, then this becomes our intermediate. Okay, for now this is what the price is doing. But if we want to look lower, like over here, we have here a short-term low, we have here a short-term low, and we have here a short-term low. Okay, this becomes our intermediate term low. If we want the price to go higher, as you can see, we are breaking this. If we want the price to go higher, it can actually come down, take this and go higher, which would be a great opportunity for us. So why am I telling you this? Because if our stop loss is below an intermediate term low, if our stop is below an intermediate term low, we can put it there and not get stopped out. Okay, we can rely on this stop loss to hold. We can put our orders below the short term low. It hits it, we have our stop loss below the intermediate term low, and we can ride with the trend wherever the trend is. So this is a tip that you could use in order to have great entries, very high probability entries. I'm currently recording a full course of advanced market structure in the Traders Club, and it's totally free. You can join. I'm gonna leave the link in the comments. And here you can see I have COT Masterclass, all the indicators that you need. I give them for free. I give you a gift. We have journaling template, weekly analysis and webinars. This is the calendar. You can see where we have our meetings every single week. I give the weekly bias of the trades that I am trading right now. I only have 30 more spots for free because I want to keep it a small circle. So if you are interested and still free, join right now and let's get you profitable. Now, if you still need more examples, I have a full video explaining market structure and advanced market structure. Watch it right now.